Welcome to Better System Trader, the show for systematic and algorithmic traders. I've got a fantastic guest for you today, someone who has had a massive contribution to the technical analysis community. He's even won some awards for his research. Welcome, Alex Spiroglou.
Welcome. Thank you so much, Andrew. Thank you so much for having me on your podcast. And I must say, I've been a fan of your show for a long time,
Thank you very much.
especially during COVID. You did manage to give me quite, a lot of company because had downloaded a lot of your interviews and I was listening to them. And thank you so much. It's really nice to be here.
Oh, great. Well, it's an honor to have you on the show. Finally, I can't believe I didn't discover you much sooner. So I must have been hiding under a rock because you've published a lot of research, and I see on LinkedIn you're epic. You publish so many things, and you've got a big following. So maybe I should hang out on LinkedIn more and discover fantastic traders like yourself. But thanks for joining us today. You're in the UK, so it's the evening. I understand it's getting very late for you. So hopefully, it's early for me. Hopefully we can figure this out together, right?
I'm sure we will.
Okay, so how about, just to get started, do you want to share a little bit of background on yourself, how you got into trading?
Absolutely. Well, it started a long time ago. Well, my interest in markets, not trading itself. At a very young age, my father was working for Bank of America. So one day he took a trip to England for a seminar. He went to Bank of America, the dealing room, the trading room. He saw it, and then he came back, and within his suitcases also came a lot of advice. Son, I think this is the best thing for you to go into a trading room and dealing room. As young as a young 15-year-old child who wanted to impress their father, I said yes, without even knowing what the trading is at the young age of 15. So I did study then afterwards in City University, City of London in England, did banking and finance. And then I started, because I had an interest in finance, but I didn't know much about capital markets. Then I started crystallizing my my view on capital markets. So, and at the so that was the first big, influence on my life, my father. The second one was at the last year of my studies. I took an elective course, which really changed my life. So the course was called at that time forecasting. It was taught by someone who later became a very good friend, Professor Roy Batchelor, who actually retired this year. And basically, Roy was an ex-life trader, but so he did use technical analysis. So, but he was he didn't want to, let's put it another way. At that time, when I said that, I'm talking about 1995. Technical analysis wasn't as accepted in the academic community. So he basically did some econometrics at the back, some econometrics at the end, put the technical analysis in between. He made it into econometrics or forecasting course. So I took that course, and that was my first contact with technical analysis. I think it was 21, 22, around that age. So that's when I learned technical analysis, and I fell immediately in love with it. Then I did my military service, finished university. Then home, worked in various investment management companies, proprietary trading houses, hedge funds, and then I kind of like retired to trade just purely my own account. In the meantime, of course, lots of things happened, but that's the short story of my life. I also run the UK chapter of the CMT Association.
Yes.
Met a lot of interesting people. So these are the very short version, without trying to bore people with my personal details.
Yeah. Well, as I mentioned at the start there, you've won awards for your research, and this is actually the way I discovered you just a few weeks ago. So I don't know where I've been hiding, how I didn't discover you earlier. But last show I had Rob Hanna on the as a guest, and he just won the name 2023 award. I think is it called the Founders Award? Yes,
yes,
right.
Absolutely.
And you actually won the year before that, 2022, and also the CMT Association Charles Dow Award. Sorry, I'm just checking my notes to make sure I get these names right. And the paper was called MACD-V, Volatility-normalized MACD, which I think is very interesting because I guess MACD and also just like standard moving averages are very, very popular indicators, perhaps maybe the most popular for a lot of different styles of trading. So how did you get into the MACD and working out how to improve it?
Right, Garo, that's a good question. Well, my quest started around, I would say, probably 2014. Well, I was, first of all, I was using momentum indicators at that time, but there are literally hundreds of momentum indicators out there. I think it's probably safe to say there are probably more indicators than traders. There are literally like thousands of indicators. So in order for me to pick one, because I was always experimenting, and as a trader who's really into technical analysis, what I was trying to do is open up the hood, if you will, and look at the math and trying to understand the quirks, the pros and the cons of each one. So what I did basically is divide them into broad categories. Like if you do a momentum indicator taxonomy table, you basically divide them in two parts. The first one is range bound indicators, like they go from 0 to 100. They also have a normalized scaling, so range bound and normalized, and the other one is unbound indicators. So I looked, that was the first thing I did. Then I started using indicators from each category. So for the range bound indicators would be like RSI, %B, %R, although strictly speaking, the stochastics. And from the other categories like MACD, which is an unbound indicator, or the rate of change, and so on and so forth. So each category has its plus and minuses. And as I started using them, I was happy in some situations to use one type of indicator, and in some categories, in some other cases, I was happy to use another type of indicator. So around 2014, my quest decided to try to use a hybrid. One would be the best of two worlds. So that's how it's all started.
Yeah. Well, before we get into that, actually, and go into that into more detail, maybe we could just spend 1 minute or so talking about the basics so that everyone's on the same page. So can you explain what is the MACD and how is it commonly used?
Perfect. All right. So the MACD is, as you know, developed by Gerald Appel.
Yep.
It was first featured in one of his books. It later became one of the most popular technical analysis indicators. I think it's by a study done by Bloomberg. It was the most popular after RSI.
Right.
So the simple version of it is it's constructed by using two moving averages, taking the difference between these two moving averages and plotting the difference. That's the MACD. So the moving average in question was the 12 and 26 period lookbacks. And the principle of it is very simple. Since you have two different moving averages, one shorter and one longer, when price, for example, rallies to the upside, the shorter moving average will react quicker than the longer term moving average. So the spread between these two moving averages will increase as there is sufficient momentum, either to the upside and to the downside. And so when you see the spread increasing, you know that you've got upside momentum. When it's decreasing, you know you've got after point you've got downside momentum. And since it's an absolute price indicator, it has its plus and minuses. I mean, the plus is that it can expand as much as price does. The minus is that it's an absolute price indicator. I mean, the absolute value itself is almost worthless.
Okay. So let's dig into that a little bit more, because I know in your research paper you went into quite a lot of detail about some of the challenges of MACD. And to be honest, I didn't know about a lot of those challenges. So maybe there are other traders as well who aren't really sure about it. Maybe can you explain what are some of the challenges with MACD?
Sure. I think I said, let me, for people to visualize it, I've got I think I said the slide called indicator evaluation scorecard.
Sure.
I don't know if it's probably I think it's slide number 3, I think it's called.
This one?
That's the one. Yeah, perfect.
Okay.
So what I did, so I've got range band indicators and I've got unbound indicators. Now, on the left part of the chart, I've got some criteria for us to objectively evaluate and compare and contrast the two broad categories of indicators. So when I talk about range band indicators, the same thing applies for RSI, percent V, percent R, stochastic, so on and so forth. And for unbound, the same thing for MACD and all the rest of it. So what I did is try to see the effects of having a normalized scaling. So very quickly, are indicator values comparable across time? So for example, for the RSI, the range band indicator category, yes, it is, because since it's in 0 to 100 range. So if you have, like, say, a 60% value, it is comparable across time. So if you go back in the 70s, you go back to the 80s, the 60% can be comparable because it's on a percent basis. So that's an advantage they have. The indicator values are comparable also across securities because it's a comparable, it's on a percent basis, it's normalized. So a 60% value on the S&P 500 is equivalently the same for the euro. And since it's normalized across time and across securities, you can create what I call a life cycle model. Basically, you can objectively define overbought, oversold, have it high-low figures when they can be comparable. For example, you can say, okay, if the market is oversold, so-called oversold, say below 30, then I'll be taking buy signal. So you can use that across time and securities. So that's the advantage that range band indicators have. Now, the disadvantages they have is that the indicator values do not adapt to trend. And that means that, for example, if there is a prolonged, this is all part of the presentation, so I'll have to be using my hands to explain what I have on the chart. So adapting to trend basically means that if a market strongly rallies, the indicator does not adapt to trend in the sense that its values being pegged from a 0 to 100 scaling, it can only go, say, within this range, so it cannot adapt to trends. For example, if the market continues rallying, the indicator will stop at these levels, and then continues rallying, it would stop at these levels. Basically, the value that you have for 70 or 70%, speaking about the RSI, is not indicative of the absolute value of the market, the momentum it has. So the market can go from 1,000 to 1,500, the RSI will go very high, and then it can triple, and then the RSI will still be, will go very high, but it will still be like 70 or 80%. So you won't get a feel for how really strong the market is. It also doesn't adapt to extreme readings. So basically, sometimes the market, you can see if it rallies very strongly, the indicator gets at very high values and stays at these values. So this is a quite newbie mistake when they start using oscillators. So they say, oh, the market is overbought, and the market stays so-called overbought for a prolonged period of time. Well, actually, it's not overbought, just very, very strong. But you cannot understand the difference because it's a limited scale of values it can have. And because of that, it's not freely able to range as much as the market and adapt with the market. The divergence signals you get are not that high quality because it cannot truly adapt. It just get pegged. So the market rallies, the indicators are sort of like flat lines. So you get this false sense of divergence. So these are the range band indicators, very quickly review, plus and minuses. For the unbound indicators, you have the reverse situation. So where range band indicators shine, this is where they fail. For example, they're not comparable across time. For example, the MACD, because it's the MACD is basically the second derivative of price. So you've got price, then you've got one moving average, two moving averages, and then you take the difference between these. So it's the second moving average, the second derivative of price. The thing is, it's not comparable across time because it gives you an absolute price, and that is depending on the absolute price of the market in question. It's not comparable across time. If there are huge fluctuations across time. So, for example, the S&P 500, because it rises, it has an upward bias, an upward drift. So, for the last 50 years, because it keeps increasing, the absolute value of the MACD doesn't reflect absolute momentum. It just reflects the absolute value of the S&P 500. So, if the S&P 500 for some reason went up to 50,000 points, the MACD value will just reflect the increased value of the MACD will reflect the increased value of the S&P 500, the underlying security, not more momentum. So for that reason, it's also comparable across securities, which means you've got the MACD of S&P 500, which is measured in thousands of points, and then you've got a market low-priced market, so a currency, euro, which is like 4 decimals. So the differences between these two moving averages the absolute value will affect the absolute value of the underlying market, not momentum. So it's not comparable across time. So consequently, if it's comparable across time and across securities, you cannot create a life cycle model when you say overbought, oversold, and so on and so forth.
Right.
So these are the minuses. So, and finally, reaching the advantages they have, the MACD itself, or rate of change, or any other kind of indicator, it can adapt to trend because since it's not normalized, as the market increases, it can adapt with it. So it can truly adapt to trends. It doesn't get pegged at high values. Also, it doesn't get extreme readings because as the market goes, so it does go, so it doesn't flat line. And thus, consequently, it has better divergent signals. So to conclude the scorecard and the indicator evaluation, you've got the normalized scaling with the range band indicator shine, and the trend influence where unbound indicators are better. And you've got the pros and cons completely opposite to each other. Yeah. So as I mentioned, 2014, when I created this like sort of evaluation, bird's eye view of how indicators are classified and where they work and they don't, my idea was how can I create an indicator which is the best of two worlds? And the best of two worlds, I mean, take the normalized scaling of range bound indicator, which is objective, compare it across time, securities, and so on and so forth, but also have an unbound indicator which doesn't have the limitations of range bound. So have an unbound normalized indicator. So that was my point of departure.
Right. Okay. So many traders, I think that was a really good slide. Thanks for showing that. Looking at the pros and cons of indicators. Now, many traders will go, okay, well, I'll just have an unbound and I'll have a bound indicator and I'll switch between them when I have to. What do you think about that approach?
Well, it's certainly doable, but it's not very helpful because you'll have to be picking the spots when you will be using one and you will not be using the other one. So, for example, again, if you're using it for mean reversion, you can certainly use a range-bound indicator. But what happens if the market starts rallying and you want to be gauging momentum? So if you take an unbound indicator, you cannot use its absolute values in any case. It won't make sense because they're not comparable across time and they're certainly not comparable across securities. So you're basically bouncing back and forth between problems and advantages. Again, I'm not saying that they're useless. It's just that they have limited uses and they have pros and cons. But by using them actively, as we can later see how we solve this, you don't have to worry about any of these problems. You can have the best of two worlds in the sense of having a normalized scaling like the RSI, an unbound indicator like the MACD. So you don't have to worry about picking and choosing in which cases you will be using. You just use one indicator under all circumstances.
Right. Okay. So having the best of both worlds sounds like a fantastic thing, and you just alluded to, or you told us why you were going to do that. So how did you, once you decided, I think you said back in 2014, you decided you were going to try and build something that does both. What did you do? How did you get to where you are now?
Well, the idea for me was so how can I have both worlds? One idea was I can unbound and normalize range bound indicator, which I haven't figured out how that would be because it's on a percentage basis, so you cannot go over 100%. So the other idea, the other option basically I had was to take an unbound indicator and try to put it on a normalized scale. And that certainly seemed more feasible. So the first option I had was to put it on a percentage basis. So I took the MACD, which is an unbound indicator, and divided by the price. I mean, divided by the longer term moving average. So you put the short minus long term, divided by the long term, multiplied by 100. So you can put it in percentage terms. Of course, that wasn't my invention, because when I looked up in the bibliography and on the internet, that was called, I think some people refer it as the PPO, percent price oscillator. Right. Others call it MACD percent. So in any case, basically, I looked at that and I said, okay, it makes sense. Basically, you have the MACD percent. So instead of having points, you had percentages like 5%, 6%. So I said, okay, there, voila, you've solved the problem. It's percentage, and it should solve everything, because we sometimes in life we compare everything by percentages, and we say that's 5% an increase or a decrease. So it makes sense. But when I started, so it did work normalizing across time. When I started applying this in particular markets, so I had a lot of numbers in the paper. Yep. So, for example, I said I plotted the PPO or MACD percent, however you want to call it, on the S&P 500, trying to find where the 95% of the values reside, and take the 5% of the values as outliers. And if memory serves, I think I found that around 2% and minus 2% is overbought and oversold for the S&P 500. So in my paper, what I did, I took three completely different asset classes: S&P 500, natural gas, and the bond, a fixed income market. So what I found is the PPO works for the S&P 500. So above 2% is overbought, above minus 2% is oversold. So I said, there you go. That wasn't easy. Of course, I saw that someone else had discovered it, but still, I mean, I didn't care about who discovered it, as long as I could make it work. So what I did is I tried to apply the PPO on a different market and try to find overbought and oversold levels. And when I tried on the fixed income market, like German bond, I found that 2% and minus 2%, which I had for the S&P 500, were completely different. I mean, when I did statistical, when I tried to find again 95% of the values when they reside, although to tell you the truth, although the PPO had been discovered, no one had plotted overbought and oversold levels on it. So that was like kind of like my contribution to that. I found that it was the 95% of the values for the bond were at different levels. So it was at minus 0.7 and 0.7. Sorry, it was 0.7 to the upside and minus 0.7 to the downside. So basically, the German bond had different overbought and oversold levels. It did work for that market, but it was different for than S&P 500. Then I took natural gas, a wildly oscillating market, and I found that the overbought and oversold levels were 7 and minus 7%, which meant that the indicator was not comparable across securities. So it could not be normalized. So yes, you can have overbought and oversold levels, but you cannot have the same ones across markets. So that really didn't solve my problem. And that means that you cannot use it for back testing. You cannot, create a normalized scaling across securities. I mean, if you've got a universe of, say, the S&P 500 constituent stocks, you have to create 500 versions of the overbought and oversold levels.
Right. Okay. So then, what was the solution? If normalizing by price wasn't, only resolve some of the issues that you mentioned there.
Well, the problem there was that. I didn't know what the problem was, and I said, okay, this is percentages, so we're comparing likes with likes. A 2% is a 2% is a 2%. I mean, why should it be different in different markets? And then I suddenly got the idea that wait, it's 2% is not 2%. It's because a 2% in S&P 500 is much different than S&P 2% on the bond. Right. I mean, for example, to put it in today's markets and for crypto, for Bitcoin, 5% is just because some trader in Chicago sneezed. For a FX market like a sterling, 5% intraday, that would be huge. That would be like a big event like Brexit. So I thought, okay, that's the difference. Let's try to normalize for volatility. They have different volatility structures. So instead of normalizing by price, I normalized by volatility. And then again, I went through the same exercise to find overbought and oversold levels, and voila! I suddenly discovered that they had the same overbought and oversold levels. And then I did it for these three markets. Then I did it for stocks. I basically tried to put it as much, and that happened. Basically, normalized by volatility was the answer. And so I was quite happy about that. Create overbought and oversold levels, what I call the range rules. And I use the term coined by my good friend Dr. RSI, the late Cardwell, and Andrew Cardwell, Andy, who passed away a few years ago. So I used his term range rules to create the various levels, 7 ranges actually for the MACD. But that was the first part of the discovery, because as I mentioned, I started this work in 2014. Around 2015, I made the discovery. Now, because the indicator itself had been normalized, you could do it. Opened up to huge a number of pattern recognition opportunities that were not previously be able to do. So again, that was another opportunity to use the some trading setups that you will not be able to do with the MACD.
Okay, so I just want to go back to that previous slide that you had, where you listed 5 or maybe it was 6 issues here. So are you saying that if we normalize MACD by volatility, all of these issues are going away?
Yeah, absolutely. So if you want to bring the next slide, when I think it's now slide number 4, when it's got the MACD on top of it. All right.
Oh, there it is.
Yeah, there you go. You got it. So let's go to the bottom, the trend influence. When it says points 4, 5, and 6, basically. Now, because the MACDV is basically a volatility normalized MACD, the trend influence part, the advantages it has, remain intact, because at its core of the engine, it's just a MACD. So the extreme reading, adaptation, the better divergent signals, and the adapting to trends remains intact. So there's no point in there. The thing that when it actually improves is the normalized scaling. And so across time, across securities, and across creating a momentum life cycle model. So if you want to switch to perhaps slide number 5, I'll show you exactly what I mean.
Here we go.
Right. So this is the life cycle roadmap, basically the overbought and oversold levels for the MACDV. The MACDV has 4 core ranges. Actually, sorry, it's 7 ranges, 4 lines. It's above 150. Above 150 is basically when momentum is 1.5 times its volatility, because the formula is short moving average minus long-term moving average over the ATR minus times 100 to put in percentage terms. So 150, it means that momentum has been purified by volatility, and when momentum is 1.5 times its volatility, then you're going to the risk level. Now these risk levels are 7 in total. So above 150, it's at the risk level. The good thing is, because the MACDV is unbound, it can go 150, 200, 250, 300. So you can really get a gauge of momentum, because at its core, it's an unbound indicator. Now, because I do a workshop on this, a presentation. If people email me, I will send them the presentation, because I've got the charts there. And what I do is I compare and contrast in similar trending situations. You see that the range band indicators get pegged, but the MACD or MACDV in this particular case continues rising. So its values rise. So when you go back in history and find that you had 250 or 300, then you know that you had really strong momentum. So the first range is the risk range, when the MACD V is above its signal line. That's the blue dashed line on the chart, and above 150. So that's first range. Now, when it starts retracing, the formula or the code for that is MACDV below the signal line, and it is between 150 and 50. So the market continues correcting, and when it goes below minus 50, that's the reversing side, reversing stage range. Basically, if you go downside momentum, so you've got the rallying range to the upside above 50 and 150, and on the downside you've got between minus 50 and 150, which is the reversing, right? Basically, it's rallying to the downside. So you've got these stages that are trashing, they're reversing, and then finally you've got the rebounding stage, which is basically when the market is oversold and then starts rebounding. And then what's really unique about it is also that we managed to solve for one of the most difficult problems that technicians or any market participant has, is how to objectively and systematically define ranging markets. So how do you define when a ranging market is? And it took me some time to sort of like think about it. And what I observed was that MACDV, as it expands, that happens because there is strong momentum. Whereas there is little momentum, it oscillates around the zero value. And I thought that's interesting. Since it oscillates around the zero value, what we have to do is basically find the time it requires to stay within a short range to define it as a ranging market. So since above 50 is a sign of a strengthening market, that is, the two moving average have diverged enough for it to indicate a strong market. So what happens if it's below 50, above 50, which is a strong momentum to the upside, minus 50 to the downside? What if it stays within this range? So the ranging range is basically when the indicator stays between 50 and minus 50 for 20 bars. So that's the definition, systematic definition of a ranging market. So I've got everything color coded, and that's how it works.
I think this is super valuable because it really gives traders an indication of where you are in that cycle, the life cycle, and what to expect next.
Absolutely.
So if we can just summarize, because you hit on a couple of points there about where the risks could be, and obviously you've got extended volatility here is a risk, but what about the nuances? Where are the other places that people should keep an eye out?
Well, basically the MACDV has some, the MACD itself has some issues other than we mentioned about. For example, it uses the signal line, which personally I don't use in because I've got two versions of the MACDV. One is the MACDV, well, the simple MACDV, which I presented in the paper. One I have a more advanced. So another problem that the MACD has is that by using the signal line, you might get late signals, because especially in high momentum environments. So that's another problem that it has. Again, there is a solution, but I haven't mentioned it in the paper. I keep it for proprietary use in a more advanced version of the MACDV.
Yeah. Okay. So I think when people use the MACD, they often use the signal line as a well, I guess a signal for whatever the condition is. Is the signal line is obviously delayed based on the calculation? Is that
exactly
fixed based when you use MACDV?
No, we have to make another adjustment. The MACDV just normalizes. It doesn't fix the signal, and the signal line is another trick on its own. So you don't get the volatility to help the signal line. Basically, I don't use the signal line for signals. The reason is because the 1226 settings is it measures intermediate term momentum. If you want to be using it for signals, you have to use something shorter, sort of like the 310 oscillator that Linda Raschke uses, which basically is a MACD at its essence. It's a 310 MACD. It's a MACD with a 310 setting.
Yep. Okay.
So
sorry, Alex, go.
So basically, yeah, that can also, I show in the paper also how you can normalize that. You have the same overbought and oversold readings. But in order to get rid of the signal and to create signals, you have to use other techniques, because especially the 1226 setting is an intermediate moment. Is not good for signal generation. At least, I mean, some can be very accurate, but by and large, it's not very accurate.
Yep. So you're normalizing based on the period of the longer term moving average, is that right?
Correct.
Okay. What happens if you use the shorter term? Have you tried that?
Normalizing by the average true range of the longer period, not the so the average true range of 26, not the long-term moving average.
Yeah. So what if you use so the default values, I think, are 12, 26, and 9, right? So what if you use 12? What if you use volatility of 12?
It will make it a bit faster.
Right.
You will get a bit more noise. So that's why. So basically, the formula is exponential. So moving average 12 minus moving average 26 over ATR 26.
Right. Okay.
Okay. So if you use ATR 12, you will still get the same results. It's just that the MACD line will be a bit more volatile.
Yep. Okay. So if you're going to use, say, for example, I don't know, 50 and 200, or you need to make sure that you adjust that volatility.
Yes. I always use the longer term. There is no value which is, even if you look at the MACD itself. If you look at Gerald Appel's work, he's got the 1226 settings, but in his book, in his later work, because he was publishing a newsletter, he used various look-back periods. So you don't have to use one. The important thing is that the normalization, and the second thing is that each set of values you use is used for a particular time. For example, you just mentioned the 50 and the 200. So obviously that would be a very long-term MACD. Now, if you volatility normalized Lindor Askey's LBR oscillator, the 310, obviously that's a very short term. You can use that for entries. And the 1226 stands somewhere in between when it's the medium term momentum. So the look back periods can be adjusted.
Right. Okay. So you mentioned Lindor Askey's 310 a few times there. Are there any other kind of, I guess, commonly known approaches that can be improved using MACD?
Absolutely. Yes. First of all, obviously the rate of change you can itself. Although I've seen it somewhere done before, if I'm not mistaken. You can also use the Kopok curve, which is basically various rates of change added together. So I've created a whole library of volatility normalized indicators. Also in the paper I had mentioned about Alex Elder's work. Because Alex Elder used the histogram, so that also gets normalized. The histogram, for those, actually it wasn't discovered by Gerald Appel. It was discovered by a gentleman called Asprey, and his work was first mentioned in the Technical Analysis of Stocks and Commodities magazine. And what they did is basically you can normalize that, and you can find, at least for the 1236 setting, the overbought and oversold level is at 40 and minus 40.
Right. Okay. I just want to dig into a little bit more about the application. You gave us quite a few examples when we were talking about the roadmap lifecycle there. We've got a question here from DK O'Leary. Let me put this up on the screen. This is a good one. Alex, do you use MACD as a regime filter? For example, if within ranging around 0, then turn on mean reversion strategies, otherwise turn on trend strategies.
Absolutely. Well, let me answer the question and then to take it a bit, take a bit deviation from it. Right. First of all, yes, I do use the MACD as a regime filter, not signal generation. And you can make a lot of filters, for example, again, mentioned in the paper. What I found is based on, again, Andy Cardwell's work, is that you can have trend-specific overbought and oversold levels. So as a regime filter, you can say, for example, if you're above the 200-day moving average, used as a regime filter of trend, you can find that the MACD itself creates overbought and oversold levels that are different if you're below it. Now, how can you use the MACD itself as a regime filter in and of its own? What I found was that the MACD has a very big correlation with price crossing the 50-bar moving average. When the MACD is crosses the zero line, of course, that's, to be completely honest, this is not a function of the MACD, but the MACD itself. So what happens is when the MACD or MACD crosses the zero line, that's very equivalent, to price crossing the 50-bar moving average. I think it has like a 98%, 96% correlation. Right. So you can use it as a trend filter as well. So by looking at the MACD or MACD with these particular settings, I can use it as a trend filter as well. Of course, now because it's also as an oscillator, momentum indicator, you don't have to plot so I never plot the 50-bar moving average on my charts. I just use the MACD for it. So that's why I'm using it as a regime filter. You can also use it as a regime filter based on the 7 aforementioned ranges. So if I want to build a screener, say a market that is strong to the upside, it's in the rallying range. So that's a regime filter. You can try your breakouts that way. Or if you want to have a regime filter for pullbacks, you can add a little rule there. Say, okay, it hasn't been in the risk range above 150 in the previous X bar. So there are a lot of uses for it.
Yeah. Okay. Thanks, Alex. So at the start of that, you said something like you don't use it for signal generation.
No,
Is there a reason
yeah,
for that?
it's too slow. It's too slow.
Too slow. Okay.
Yeah, it's too slow. For example, I mentioned this in the paper. I mentioned the problem, but not the solution. Again, the solution is a bit proprietary, but I showed an example, just people who are aware of it. So if the market is, for example, if I remember correctly in the paper, I had the 1987 crash or something like that. But I'm sure you can find the equivalent in other markets as well. So basically what happens is the market has a very strong momentum to the downside. The MACD or MACD will react much quicker than the signal line. So there will be a wide gap between them, which means as the market recovers and the MACD or MACD turns to the upside, adjusts to the market, and by the time it crosses the signal line, the market will have had a long way to the upside. Yeah. So it's too slow for signal generation. I mean, for trend definition purposes, it can be okay. So you have to find a way around that to make it quicker.
Yep. Okay. I guess another common way that the traditional MACD is used in trading is divergences. How does normalizing by volatility impact that? Is that still a viable option?
Absolutely. Absolutely. And the thing is, now you can quantify them, the divergences, because what I do for the advanced version of the MACD is take the swing points. So for example, if the MACD has swing high, swing low, swing high, swing low, and so forth, I label, name them, but I do that going from right to left, not left to right. And I can use that for a backtest. So you can say if the market makes higher swing highs and higher swing lows. So that would be the definition of high one being higher than high two and low one being higher than low two. Then I apply this swing structure, if you will, on the MACD itself. And now I can start having creating definitions of divergence. So the systematic way to define a divergence would be the market making swing high and higher swing highs and higher swing lows, with the MACD making lower swing highs and lower swing lows. And then the formula for that will be very easy to program.
Yeah. Okay. Now I just want to dig into a little bit more about how you actually use this in your own trading process, because I know this is just one piece and you have like a multi-timeframe, multi-factor approach. So can you talk a little bit about that?
Absolutely. Yes. Well, let's start from slide number 1. I think that's probably the way. Well, it's always that's
this one.
Yeah. Okay. It's always has been my belief that using different time frames, and my time frames is like monthly, weekly, and daily, there are different return drivers in each time frame. So different factors affecting the monthly time frame, different the weekly, and different the daily. So and the issues I struggled with when I first started is, one said, look at the fundamentals, one says look at the technicals, one says look at say for example production, look at inflation, look at the RSI, whatever. So what my issue was, okay, to try to pigeonhole or classify the factors that are important each time frame, and then have it in a step-by-step roadmap, so I can sort of like understand what's going on and then start to programming. So on the monthly chart, what I do is I use the business cycle. There are various ways of defining the business cycle. My favorite one goes back into the work of Martin Prigg, his 6-stage cycle model he has, using the 3 asset classes: bond, stocks, and commodities. Now that can be further improved, but that's an excellent starting point. And then on top of that, you can also add economic indicators. So that's the first time frame I use. And then I go into the weekly chart, which is my setups. Again, this I don't take any action, that just is my setups. So this is my macro, and my macro I use 4 factors. That's the commitment of trader report, sentiment, seasonals, and sorry, my mind got stuck. Oh yeah, there you go. And sentiment, seasonality, and the business cycle. So it's 4 of them. And then I go to the daily, which is the technicals. And technicals, basically, that's where when I actually go to see the market in the what I call the core 4 of technical of price action, which is trend, momentum, volatility, and relative strength. And then I'm going to take the trade. And the trade is partitioned in 4 parts, the 4S framework: setup, signal, stop, and size. So if you're gonna go to the next chart, when I've got it like sort of the you look at it in a step-by-step fashion. I think it's there you go. So these are my macro factors at the bottom, because fundamentals answer the question why markets should move. Markets move for fundamental reasons. They don't move because of a trend line breaks or an oscillator or the MACD. And then I go to the technicals, look at the trend, momentum, volatility, and relative strength. And I've got the MACD box in red, just for people to understand where it comes in the big picture of things, because I don't want to be passing the MACD as the holy grail of trading and the be all and all. It has its place. I mean, it's important, but it's not everything. So you've got fundamentals, and even within technicals, you've got 4 different other, another 3 aspects. And then I use this as a setup. Then I've got the signal, the stops, and the size.
Okay, I think this is really helpful to see, because traders who are watching are probably thinking, okay, how do I go and apply this now?
Combine.
You've got quite a sophisticated approach here with multiple layers. What do you recommend to people who are maybe not just starting out, but they want to apply this MACD? What should they do?
Well, it depends. If you want to be using it for purely technicals or for fundamentals, basically it's a momentum indicator. It can help you identify high momentum, low momentum indicators. Now your signal. Let's take the simple version, the simple answer, where you just I would say get rid of, because in my heart I use technical and fundamental answer a lot. But let's keep things simple on a technical basis. So if you've got, for example, a signal generating mechanism, a bar pattern, because I also use bar patterns. Basically, signal generating mechanisms, as far as I'm concerned, can come either from 2 categories, either indicators or bar patterns. So, for example, a double intraday range breakout, that's a bar pattern. It's got nothing to do with indicators. You can use it as a regime filter, either trend. Obviously, buy signals will work better if they are in an uptrend. But within that uptrend, can you find other regimes? I mean, other sections in the data where it works even better? Will it work better as when the MACD is above 50, when it's in a very ranging environment? When it is rebounding, again, you've got strong upside momentum for different reasons, on the rallying and the rebounding range. or you can see what happens where in the ranging range. So again, you can start looking into fine tuning your existing patterns based on momentum. Obviously, you have fewer occurrences, but you'll find that you have better quality setups.
Yeah. Okay. All right. Well, we're almost at time, Alex. So we'll start wrapping up in a few moments. But I just wanted to ask you. I really like this volatility normalization technique, and someone in the chat mentioned that Timothy Masters also writes about this in one of his books. You kind of you mentioned, I think you said rate of change was one of the ones that you also tested for volatility normalization. Where else do you think that this approach could be handy to adjust how indicators work? Can you give us some clues? Other indicators?
Other indicators. Well, actually, I'll be start publishing again this on TradingView. Well, basically, you can use volatility normalization in any kind of unbound or absolute price indicator. So you can use it on rate of change, the Copo curve. There are many indicators, which again I'll be publishing for free on the TradingView, because right now the MACD is being programmed into TradingView, Metastock, Optima. A lot of people have done it in Ami Broker, in its TradeStation, Bloomberg. So along these platforms, I will be putting these indicators as well. So to come back to your question, anything that is as an absolute price indicator, you can use it there.
Yeah. Okay. Well, maybe that's a good point to say. I know you've got a slide here. Let me put this one up on the screen. So how can people get in touch with you?
Absolutely. So yeah, if basically, if anyone is interested in knowing more about this, first of all, I can send them the paper itself. It's an excellent read for people that suffer from insomnia. So if anyone has problem to sleep by reading the paper, that should solve that. Also, the MACD indicators, both the MACD and the histogram itself, are right now being programmed. It should be published very shortly in TradingView. It's already in stock charts, in Metastock, in MT4 and Optima. You can give you the code if you got it on Bloomberg terminals and Ami Broker. I mean, it will be across all technical analysis platforms. And also, I did recently. I've done it many times, but very recently I did it on for the IFTA, International Asset Federation of Technical Analysts. I did a webinar for them. So send me an email. I'll send you the webinar for because we will go into a bit more details. So send me an email if you've got ideas. I would really, really like to exchange ideas. If someone can even improve the work I have done, or just to say hi, I would be more than happy to be contacted by people.
Yeah, okay. I watched that IFTA webinar a couple of days ago during my research. It was really good. So you go into more detail, some of the things we kind of just brushed through today because of time constraints. So if people want to know more about that one, I'll actually put the link as well. I mean, you can contact Alex and I'll put the link in the description below the YouTube video.
Absolutely.
So
and to tell you the truth, the webinar I did, that particular one is quite introductory. So I'll have another one which will be a lot more advanced, because that's just a closing comment. When I created the indicator in 2000, I found the question in 2015. Up until it was published in 2022, I was doing a lot of work. I had no intention to make it publicly available. I mean, just write any paper on it. So I did a lot of work on it. So when 2022 came in, I said, okay, let's make it widely available, and I'll just write a paper to make it a bit more formal rather than just make a blog post. And but by that time I had done a lot of work, and obviously for the needs of the paper, I only published a certain small amount of information. So there's a lot of more meat on the bone, if you will, rather than that just on the paper. And I will be following up with more advanced webinars. Okay,
excellent. Well, thank you very much for your time today, Alex. It's been really great speaking to you, and thanks for sharing your research. And I can't believe you published this 2 years ago, and I've only just found out about it. So I need to get better at my research, I think. But thank you very much for explaining this today. And so before we go, any closing thoughts?
Absolutely none. I'm glad to be part of the Better System Trader people that you have invited. It's a very, very good post. You do a lot of good work. Getting people
Thank
to
you.
share their work and getting to for us to get to know knowledge that we actually wouldn't have been able to access. So thank you so much, and do please keep up the good work and continue with the podcast. A lot of people, I'm sure they get a lot of value from it.
Thank you very much, Alex. That means a lot to me. That's the idea behind the podcast is just to share knowledge and from there's so much good stuff going on in the technical analysis and algorithmic quant-based communities that I think it's really valuable to just speak to people, even if it's not the way you normally trade, or there's always little things that you can pick up. And I really like I guess my big lesson from today from you is volatility normalization. So I'm going to go and do a lot of research on that. And we're getting some thanks in the chat as well. Let me just put a couple of these up on the screen, and then we'll finish up, and you can go to bed, Alex, and I can have another coffee for breakfast. So Kip said, looking forward to more advanced webinars. And then Kip says thank you as well. Giuseppe said thanks. And here we go, one last one. I'm looking into MACD. It looks interesting. Thanks for sharing. So thanks again, Alex, and thank you everyone for joining us today. If you enjoyed the video, don't forget to hit like and subscribe, and you'll be notified of any future content that we release. So thanks again, Alex, and all the best.
Thank you so much. Thank you. A big thank you to everyone. And again, please do contact me if you've got any questions. I'll be more than happy to share my work.
All right. Excellent. Happy trading.
You too. Thank you so much.